We're here to talk about Silicon Valley real estate market conditions for October the 19th. We're going to start off by looking at three key indexes: the active number of offers and the days of unsold inventory. We're doing a ratio between the current values and the 10-year medians. Then we're going to look at the performance of Silicon Valley over the 10 years. So you have the actual metric in the purple. You have the gray line where you expect it to be. Blue is, or in this case, it's inventory, so the most you'd expect, and red, the least inventory you'd expect. So you get some idea on how it's hot or cold. Then we finish up this section with a summary of the key indicators for the past 14 weeks, which is a quarter plus the bookends of the quarter. You can see how you're doing more recently on the key indicators. Then we take three distributions: days on market, ask price reductions, and overbidding. And then we come back and we look at the three counties, and this is to give you a breakdown. And I believe the breakdown is very important, not only on the county level, which is still not far enough, but I break it down even further into 20 different micro market areas. Then we have a recap of those 20 micro market areas, so you can see the conditions from starting on the micro market area or your payment or price range, and see what kind of market conditions you'd expect if you were a seller or buyer. Then we have the raw data. We compare the past 25 years on the sales volume, and we're noticing that the sales volume is coming up. We'll talk about how to participate and how to ask questions and reach out and how to get the handout of the PowerPoint slides. And then we finish up with a quick overview of the Northern California 13 counties and 5 regions. And the value of this is not that I expect buyers to use the Northern California data, but in examples like right now where we're seeing the number of offers taking off, it's nice to see it's a global trend versus a local trend. So let's jump right into the data. We're going to start off with a different slide than normal. And what I wanted to point out here, this is the number of offers accepted in the past 5 weeks in the 5 regions in Northern California, which covers 13 counties. Notice how dramatically 4 of the 5 are going up. And almost more important, or equally as important, is notice how, like, the North Bay, the gray line, is currently on the right-hand side above the peak for the last 2 years. The same with Central Valley. It's above the level of any time during the past 2 years, as well as the cities area. If you look at Silicon Valley itself, we're slightly below our peak of this year, but that was the peak. So we're at the highest level of offers any time in the past 2 years, except for a very small window midway through second quarter. It's a very unusual time for this level of increase in offers to be happening. Yes, there's always an increase in the volume, but when you go back to past years, the volume increase in the fourth quarter, basically the month of September, October, is always less than it was the previous peak, sometime during second quarter. So the fact that 3 of the 5 regions are higher than the peak and Silicon Valley is close to the peak is pretty significant. So something's going on with the buyer's interest in doing the number of offers. So that's a huge increase. And the increase occurred starting basically here, which was Labor Day. So since Labor Day, there's been a huge increase in buyer activity. And I know people's initial reaction is going to be, oh, the interest rates dropped. That's too fast for it to explain. And interest rates are back up again as far as the national average. So I don't believe it's as simple as the drop in interest rates that was short-lived. Moving on to a more traditional start, we're looking here at the 3 major components of Silicon Valley. Purple line right here is the level of inventory. So the inventory now is 90% of where you'd expect it to be based on the past 10 years. So there's a shortage of 10%. The offers being accepted is down here at about 84%. So there's a shortage of 16%. And you would expect, because the shortage of offers is greater than the shortage of inventory, you'd expect the days unsold inventory to be above the normal level, but it's actually below. And I have checked my math. And the reason this works out is the median level for each one of these 3 components happens in different years. So even though right now you have more inventory than you do offers, the market is actually quicker than it typically is based on the past 10-year median. Now, looking at the individual components for Silicon Valley, what we're doing here is the gray line here is the 10-year typical. So that's the pattern you'd expect, barring any insights. The red line is the hottest, which is defined by the 10% least amount of inventory. And then the blue line is a cool marketplace, which is the 90 percentile. Basically, you expect the level of inventory be between the three lines here. You'd expect it to be on the typical line, and then you wouldn't expect it to vary above or below by more than the red or blue. Now, obviously it does, because you get to the 100 percentile. So here you're actually below the red line, and here you're above the blue line. So the lines are not absolute, but you have an 80% confidence factor that it's going to be between the blue line and the red line. Following the normal pattern, rolling over, and the level of inventory is decreasing, and that's true. It's decreasing in 11 of the 13 counties I follow. I believe the two counties that are still seeing an increase in inventory are Solana and Napa, both in the North Bay. All the other 11 counties are seeing a decrease in inventory, which is very common for this time of the year. You can see, again, we typically have this little dip down for the Labor Day, and then you roll up afterwards, and then you come down. Basically, a lot of people don't understand August is actually typically a low number of, not low compared to December low, but low compared to July and September as far as the number of offers accepted. And then the inventory starts to roll over, and by Halloween, which is now only 2 weeks away, it really starts dropping off. Now what we do is we pull out that gray line and we call that normal, and we see how the raw data, the purple line, varies compared to that normal line. And you can see right now you're down here at somewhere like 90%, and you've been fluctuating, but we've actually been gradually improving. So the level of inventory has been slowly improving. If you come back here to our low and draw a straight line sort of through all this data, you can see you've had an increase, but we got all the way down to only 60% of the inventory that you would expect to have. We're now back up at 90%. Moving over and doing the same thing with the number of offers. So here, a low number of offers is a cool marketplace, which is why the blue line's on the bottom of the gray line. You can see the rapid increase in the number of offers, and this is Silicon Valley, which was one of the 5 regions that wasn't at its all-time peak. So you can see that we're below our peak for 2024, but we're above any time that we had the volume of sales we had in 2023. And we'll be seeing that in my low offers chart as well. But again, it looks like we're starting to roll over, and with the sharp drop off being basically a cliff in most weeks, I'd almost expect next week to be down. There's a chance it could be flat, but my expectations would it would be below the current peak. Pulling out, you can see that the rapid increase compared to normal that I'm talking about, we went from basically somewhere around 72% of the offers you'd expect all the way up to 86% of the offers you'd expect, and we're now down to 84% of the offers you'd expect. Going from 72 to 86, that's a pretty significant increase when you did it September the 6th through October the 11th. Last week was the peak. Now looking at days unsold inventory, this is the turnover rate of the marketplace. You can see that we have been above the gray line, below the blue, so slightly cooler than normal. And now basically since October the 1st, we've been basically right on the gray line. And if you come down here, we're actually now a little bit below. So we're actually having a slightly higher turnover rate than you would expect based on the past 10 years. Here's the pulling out that gray line. And again, here you can see last week was sort of the fastest week. We've slowed down a little bit this week, but we're below the gray line. On days unsold inventory, the turnover rate, the lower the number, the faster the marketplace is. So the fact that you're on the low side of normal is in hot marketplace, which is why the pink shade down on the bottom half of the gray line. Moving on and looking at marketing time. This is simply an easy to understand stat. It's how long does it take 3 out of 4 sellers to sell their property? You don't want to look at how long it takes, the 90th percentile to sell. I may be increasing this to the 80 or 85th percentile, but I'm still trying to make up my mind on that. But it's sort of the long typical seller. Why you want to increase it? See the step functions down here on the red line? You want to get away from that because you can see that you have these stair functions in the purple line. You don't want to have stairs. The reason you don't want to have stairs is when you're on that horizontal part of the stair, on the step part of the stair, you have no idea if the market's improving from week to week or not. Now, granted, the stairs don't last very long, and you can see you have a staircase going on back here in 2023. That's what I'm trying to avoid, but still have data that reflects. I like the 75th percentile, but I'm hoping that the 80 or 85th percentile will get rid of my stairs or at least decrease them significantly. But again, you're basically having very close to the normal level, slightly faster than normal, and that's after we spent most of the year slower than normal because we were basically from midway through second quarter through all the way through third quarter, we were above the gray line. We were slower than you'd expect. Now, basically, since Labor Day, we've turned around and accelerated, and we're now faster than you'd expect. Here, again, it's the same data where you pull out that gray line and then you plot the purple line to it. You can see that we spent the second half of second quarter, all of third quarter, slower than you would expect, with the months with third quarter actually being very slow compared to normal, and now we're faster than normal. Here's the seller's ask price, and this is pretty unusual data, but I believe it's a good way of doing the representation because the vast majority of the sellers do no price reductions. Here, instead of looking at the average and the median, I'm looking at the sellers that take the largest 10% price reductions on their ask price and plot that compared to normal. So the gray line is your normal price reductions, the purple is the actual data, and you can see that you're on the blue side, the cool side, or larger price reductions than you typically do. The way you read this graph is a little confusing, but you come over here and that would be about 87. So that's a 13% price reduction off of the 100%, which was their original ask price. So you can see that even in a hot marketplace, sellers here are taking about an 8% or maybe even a 10% price reduction. The reason that's such a large price reduction is it's only the sellers that are taking the biggest price reductions. So you're ignoring 90% of the marketplace. Again, here, 10% of the sellers are taking a 13% price cut. Compared to normal, that's cooler than normal. That's 20% more than normal. And that's not 20%. So the normal number would be maybe something like, let's call it 11%. So if you take 20% more than 11%, you get to that 13% price reduction that we were seeing on the previous slide. So this is percent compared to normal. So we're taking roughly, I call that maybe about 17% more price reductions than normal currently. Now we're looking at average just to try to show you, and it also shows the difference in the data. When you look at the average of the typical seller, he's right, they're taking exactly the normal price reduction, and they're only taking 1% price reduction. And that's, 1% is probably not enough to make much difference, but it's surprising that a 2.5% price reduction is actually very significant. And that's part of the reason so many sellers take large price reductions, is it really shifts the dynamics of the marketplace. Also, sellers and listing agents do a lot of homework before they pick their ask price, and they're putting their house on the market typically to sell it, and therefore they've priced it right, which is why we have so few price reductions. And frankly, when you look at time to sell, you don't have enough time to do a price reduction. Here's your price reductions compared to normal, and you can see, looking at the average price reductions, we're right now at that normal level of price reductions. So you're right where you'd expect it to be, 100% of the typical price reduction. It is a price reduction because zero price reduction would be up here and would be a hot marketplace. And you can see there have been times like back in 2022 where sellers were on average were actually raising their price, and that doesn't happen very often. It makes sense that the hot marketplace comes down below zero price reduction and is somewhat above whatever the typical price reduction is. So right now we're having a typical price reductions. This is seller's ask price frequency. So the last slides were on magnitude. This is the frequency. So how common is price reduction? And again, the purple line is below the gray line. Here, your red line is below. So that's a hotter marketplace. So right now, 16% of the sellers are taking a price reduction in Silicon Valley. That means 84% of the sellers are not doing a price reduction. Compared to normal, that's actually 90%. So it's fewer price reductions than you'd expect. That's by 10%. So if it's at 16%, normally it's somewhere around 17.7%, and you take 10% off of that 17.7 and you get to 16%. Here's your median overbid. So we're flipping over now and paying attention to what the buyers are doing. And this is sort of the competitiveness of the marketplace. But here's the typical overbid. The typical overbid would be somewhere around 2.25% is typical. Right now, you're at about just shy of 3.5% overbid. Now that's the median overbid. Half the buyers are overbidding greater than that, half are overbidding less than that 3.5%. The other number that I throw out here at times are the average, and the average is going to be higher than the median. In fact, I think it's somewhere around 6 or 7%. Here you can see the overbidding magnitude compared to typical. So typical would be right down here on the gray line, and it's 2% greater overbidding than normal. Here's the frequency of overbidding. So typically your frequency of overbidding is down here somewhere around 64%. And currently we're up here at just shy of 68. So we'll call it 67 and 2/3, just because that's 2/3 of the marketplace doing a overbid. So 2/3 of all buyers in Silicon Valley are going in over the ask price because they feel they need to try to ensure that they get the property they like. The frequency of overbidding is now currently about 5% above where you'd expect it to be. We're sort of in that threshold of a hot marketplace. Normal would be right down here at 100% of the frequency of overbidding. Here's your long-term price appreciation on law paper. So the straight line is your long-term appreciation, and that's just an estimate of the actual number. I have not calculated it. And there's two takeaways from here. Typically, the price goes down at the end of the year, down at the end of the year, and then it overshoots in the second quarter sometime typically. Now, the timing of it may change a little bit. You can see the peaks are typically sometime in the second quarter. Here, you're right at the end of first quarter. Here, you're right at the beginning of third quarter. But basically, sometime during second quarter, you'd expect a peak, and that's exactly what we had this year. We sort of had a plateau. What is a little bit unusual this year is the amount of the decrease and coming back down underneath the line and then sort of increasing at the normal rate of the line. I would expect further decrease at the end of the year for the holidays. It typically happens. There are a couple years where it doesn't happen, like here in 2021 when we were coming out of the pandemic. But pretty much every other year, you can see some sort of valley at the end of the year. And that's not necessarily property values, but it's more the market mix, but it also does tend to influence property values. Here's the estimated payments for the typical property here in Silicon Valley. You're going to come in at about $11,250. The most expensive homes up here are $26,000, and the most affordable, the 10% home, is down here somewhere around $6,500 a month payments. That assumes an 80% loan at the federal average rate right now for a 30-year fixed mortgage, and you can get more attractive interest rates than that. Now we're going to do a summary of sort of what we went over to. Here we're only going back for 14 weeks. 14 weeks is 1 quarter with the both ends, which is how you get to 14 versus 13. If you're starting off with inventory, you were at 2526, you're now at 2570. So inventory is up a little bit, but basically call it flat, and that you can see that because the purple line is basically at the same level it was here. But compared to normal, which is comparing it to the gray line up here, which is with the typical marketplace, you can see the vertical separation here on the left-hand side is much greater. So we were only at 83% of the level of inventory you'd expect a quarter ago, and now you're at 90.3% of the level of inventory you'd expect. So still a shortage, but we've improved the level you'd expect. And that's not because inventory has really grown, although it has by 44 properties. It's more that normally inventory is going down, and you can see that because the gray line on the left-hand side is slightly higher than the gray line on the right-hand side. And flipping over and looking at offers accepted, you can see that we started off at 73%, and we were actually below the blue. But 14 weeks ago, we were accepting less offers than you would expect in the slowest marketplace. We crossed over 3 weeks ago, and now you're quite a bit above. So your level of offers have gone up from 1,970 offers to 2,271. Now, that's not a record for this year in Silicon Valley, but it is a record high in Central Valley, North Bay, and the cities, as I showed earlier at the very start. But what's also noteworthy is you've climbed from 73% of the offers you expect to 83.8%. So you've climbed almost 11 percentage points out of the level of offers. So the buyers are definitely coming back in the marketplace, which is a very encouraging sign because it's been the lack of buyers, which is what we've seen for a long time now. Speed of the marketplace is measured by the DUI. It's a balance between the number of sellers and the number of buyers, how quickly you'd expect the market to turn over in a theoretical marketplace. Never happens. 45 days a quarter ago, you're up to 49 days. So the market has slowed down, but compared to normal, we were at 12% slower than normal back on a quarter ago. And now we're 3% faster than normal. You can see that you went from the purple line was above the gray line on the left-hand side, and now you can see that the purple line is below the gray line on the right-hand side. So the market has slowed down a little bit, but it's actually sped up compared to normal, and that's because the market normally slows down at a greater rate than it did this year. Moving on to time to sell. This is the 3/4 of sellers sell. We started off at 24 days. We increased to 26, which is obviously a slowing down of the marketplace on the right-hand side of the marketplace. But now if you look at it, we were 20% slower, longer than typical on the left-hand side, and now we're 2% faster. So even though it's taking 2 full days longer for the sellers to sell their property, this 26 days is basically exactly normal, where this 24 days was about 4 days longer than it should have been. It should have been about 20 days back here, which was why you were on the slow side of the gray line, and now you're barely on the hot side of the gray line. Price cuts, you went from 0.5%. I need to look at these percentage numbers, don't really make sense, because this should be the average overbid, so that should be like 99.5%. I didn't need to look into that. I'm surprised that I didn't catch that before. But you went from 20% more price cuts than you would expect, because the purple line is on the cool side of the gray line, to here where you're right on top of the line. So you're at 98.3% of where you'd expect the market to be. You're right on top of the line. Overbidding is started off exactly where you'd expect it to be, 0 difference. You were exactly at the market with a 6.7% price reduction. But here you're at 6.5% now, so you're 0.2% lower overbid, but yet that's 1.8% higher than you'd expect it to be. And this is in real terms. So typically you'd expect this to be down at 4.7%, and yet it's at 6.5. So the amount of overbidding is now quite a bit higher than you'd expect. And you can see that by the separation. The purple line is coming up from the gray line and getting to be greater and greater. So now you're almost 2% more overbidding than you'd expect. Now we're going to focus on days on the marketplace. This is simply showing you the distribution. 10% of the sellers are on the market for a very short period of time. 50% of the sellers were currently on the purple line are on the market for about 11 days. 75% of the sellers are on the market for somewhere up here around 26 days, and 90% of the sellers have sold when they are on the market for something like 54 days. What we're just doing is we're looking at a week at a time. My data is always on a weekly basis, but we're going to jump 4 or 5 weeks to try to keep it to the same date. The blue dash dotted line is where we're going to start off, and that was a year ago. The purple line's up here, so it's taking longer for the seller to market their property this year than it did last year. Last year was a faster marketplace, and we'll step through. You can see the market slowing down last year, and I expect it to slow down. There's coming up on the peak of the market. That's probably the peak for this week. Now you're slow down, and now you're going to get in this time frame, which is basically the summer plateau, and it just bounces around a little bit. The solid lines that we're about to get to right there are the most recent. So that was the slowest. Now we've improved a little bit and continue to bounce, but we're rapidly approaching, and there's the purple line, the current week. We're rapidly approaching the time of the year where I expect this market to start slowing down fairly significantly for the end of the year, like we saw at the beginning of the movie. Now doing the same thing for sellers' ask price reductions. You can see that the purple line up here is above the blue line. So now we've reversed, and we're actually a hotter marketplace on price reductions. So sellers are doing fewer price reductions than they were last year. And this is a reversal from just last week. Last week, the purple line was cooler than it was a year ago. And you can see that we're pretty close through bulk of it. And right up here at the top of the marketplace, it actually reverses and it cools. But in general, I would say that the purple line is on the hot side of the blue dash dotted line. So starting off and going through a month at a time, roughly 4 or 5 weeks, there's sort of the bottom of the marketplace. Now you're rapidly going up for the spring. There's the peak of the marketplace. Now you're cooling off. And now basically starting around July 19th, you're at the summer plateau. And you're just basically bouncing around and really not changing very much. Now you got the most recent data. There you're at the sort of the coolest marketplace right there. Now you're warming up a little bit, and that's a pretty significant increase. There's another increase. And now you have where we are on the purple line. Because of the time of the year, I would expect this purple line to be moving down, but the real question is how quickly does it move down compared to normal? Overbidding, this is flipping over and looking what the buyers are doing. And here, for all intents and purposes, the purple and the blue line are on top of one another. And I also believe last week the purple line was cooler than the blue line. So again, we're seeing an improvement in the marketplace in this because it requires sale price has a lag time of about 5 weeks typically. We're going to step off a month at a time roughly. There's the bottom of the marketplace. Now you can see the run up and jumps up pretty significantly. There's sort of the peak of the marketplace, April 19th. Now you're coming down, and now you're starting to be in the summer doldrums and, you know, basically the plateau where it just bounces a little bit from week to week. Moving on to the solid lines right there. Now you can see that you really, because you can see the purple line, you know, really at the same level. But again, once we get to the purple line right there, I would expect the market to start cooling. So I expect this line to be dropping down each week going forward just because of the time of the year we're at. Real estate is very repetitive on an annual basis. And that's why I do all this stuff on an annual basis. Now what we're doing is looking at the active inventory for the 3 counties. And I think this is important to start understanding that, yes, what we've been talking about is Silicon Valley, that gives you a good understanding of what's going on. Now we're sort of looking at what's happening on in the county that you're looking in. And then ultimately we'll get down to the micro market areas. On the market conditions you'll see in one of the 20 micro market areas I follow in Silicon Valley. You can see Alameda County has the most inventory, just over 1,200, followed by Santa Clara County at somewhere around 875. And then the least amount of inventory is in San Mateo County. It's also the smallest county at about 475. Offers accepted. Santa Clara County is basically selling as many homes as Alameda County, and Alameda County had more inventory. So Santa Clara County is going to have a faster market pace, a higher turnover rate, a quicker turnover rate than Alameda County. And the slowest one, or the least number of offers, is San Mateo because it's just a smaller area. Now, when you're comparing the speed of the marketplace, you're comparing all 3. Look at this dramatic increase in the speed, decrease in days of unsold inventory in San Mateo County. You went from basically 45 days down to about 36 days, and you did that basically in a week. So there's been a huge change in San Mateo County, and we can go back and look at that. You see an increase in the number of offers right there. That's, you went from 400 to 450. That's a 10% increase in the number of offers. And at the same time, the inventory went down. So you combined with a decrease in inventory, an increase in the number of offers in San Mateo County, leading to this huge quickening of the market turnover rate. Santa Clara County is still the fastest marketplace, but San Mateo now is catching up rapidly. And then Alameda County is the slowest and still very respectable. It's going to take 46 days to sell all their inventory. Here's marketing time. Alameda County similarly has the slowest marketing time at about 33 days, so just over a month. San Mateo County is second at about 26 days, and Santa Clara County is the fastest at 20, just under 3 weeks. This is price reductions. Alameda County has the most price reductions. Santa Clara and San Mateo County are tied. Frequency of price reductions. Most frequent price reductions with almost 20%, 17% of the sellers in Alameda County doing price reductions, almost 16% in San Mateo County, and only 14% in Santa Clara County of the sellers doing price reductions. Overbidding, the highest overbidding is in Alameda County. And this is back to the average overbid that I referenced earlier. Earlier, I was tracking the median, so I flipped that around a little bit depending on what I'm looking at. It's sort of unusual that Alameda County is the slowest marketplace, but it's the most overbidding. And I think what's happening there is the market's slow enough that sellers are doing price reductions, and then buyers are coming in and overbidding the now reduced price. And Santa Clara County and San Mateo County are on top of one another at about 6% average overbid. Here's the frequency of overbid. All 3 are very close together at about 2/3 of the sellers. So it's about 2/3 of all transactions. The offer price is higher than the list price. Here's the long-term appreciation. Santa Clara County has by far the highest appreciation, up here at about 105% appreciation. Prices are double what they were in 2015. San Mateo County and Alameda County are right on top of one another at somewhere around 67% appreciation, which is still fairly respectable. You're talking, 10 years worth of appreciation. And if you leverage that out and you've, done a 70% increase and a 5-to-1 ratio, you've tripled your money. Here's your pricing. It's also very noteworthy that Santa Clara County is above San Mateo, and it's increased the amount a little bit. And it's still a fairly small number. I forgot what it was. It might have been like 10,000 last month. It might be 40,000 this month. So very close together, but it is very unusual to see Santa Clara County above San Mateo County. You can see the blue line has always been below the orange. You equaled here. You have a couple hits where you're equal. You were slightly above right here. You were above at the end of 2024, right through here. But right now we're again above, which is just an unusual situation that we didn't see before the pandemic. Basically, the pandemic's taken away the premium to some degree for living close to work. Also put in the horizontal line so you can see that Alameda County is below their 2023 pricing. Both Santa Clara County and San Mateo County are above. Santa Clara County is more above than Santa Mateo County. Here's the same information on regular paper for those that prefer. The previous was on logarithmic paper. Here's the estimated payments. You can see that Santa Clara County is going to have a higher estimated payment than San Mateo because of the higher sale price, and Alameda is going to be the most affordable. So the median price home in Alameda County carries about a $9,200 PITI payment. That's the total property tax and insurance, and it's only estimated because there's no way for me to know what an insurance policy is going to cost on every house. Now we're looking at the micro market areas. We're starting off at inventory. The big takeaway here is you see a couple areas of pink, but basically you got normal levels of inventory. I've added in Silicon Valley, the counties here, San Mateo County and Alameda County, so you can see what's happening at the county level. Number of offers, you can see the blue is less blue than it has been, but we still have quite a bit of blue, which indicates our lack of offers. So even though the offers has improved dramatically recently, it's still a lack of offers. With Silicon Valley as a whole only at 87% of what you'd expect, Santa Clara County at 88%, San Mateo County at 92%, so San Mateo County is doing better, and then 86% for Alameda County. This is the speed of the market, the turnover rate. Here the lower numbers are a faster market, higher numbers are slower. You're basically at very much normal numbers, very white in color. You got a couple slow areas in San Mateo County where Redwood City is 30% slower than it typically is, and San Mateo County, the coast, is 42% higher. So San Mateo has some significant areas of blue. The area of blue in Santa Clara County is South County, but basically you have normal speed of the marketplace. Here is now just looking at the speed of the marketplace, no longer comparing it to normal. This gives you an idea of how quick it's turning over, basically 39 days. Santa Clara County is at 34, so it's faster. San Mateo is down here at 36. And then Alameda County is at 37. So Santa Clara County is the fastest. And you can see that most of Santa Clara County is in the red color. You can see the Fremont, Union City, and Newark area. The Tri-City area of Alameda County has also got a fast moving marketplace. Here's marketing time, also very related to the previous, but there are different metrics and you get different readings. So like the coast was really slow in this theoretical speed of the marketplace, but their time to sell is pretty reasonable. And what that's saying is sellers are either selling right away or they're not selling on the Pacific coast because they're at 43 days, which is only a little bit slower than longer than the normal. Here's your ask price reductions, and again, fairly typical. You can see a fair amount of very light shades of blue in Alameda County and in San Mateo County. Santa Clara is pretty much white in color. Here's the frequency of price reductions. The frequency is indicating there's not very many sellers. So the sellers that are doing the price reductions aren't as much as you'd expect, because that's why it's red in color. Or maybe my color coding's off too. I'm seeing an error here in East San Jose. 10.4% of the sellers doing a price reduction. It should be the same as the Milpitas at 10.6. I have my color reversed. This should be a red in color, not blue in color. Sorry about that. Magnitude of overbidding. You can see, even though we've had the market we're seeing, we still have a fair amount of overbidding. And this is the average overbids for each one of the regions. In Santa Clara County, you can see the average overbid is 6%, which is lower. 6.5% is the whole Silicon Valley. San Mateo County is at 5.9. So Alameda County's got to be faster at 7.3. Yep. So Alameda County is pulling up Santa Clara and San Mateo counties. Here's the frequency of overbidding, fairly red in color. So that says that there's a the frequency of overbidding is very common, even if the magnitude of it is not that high. Here is your appreciation. You can see that the San Mateo County area related to the pandemic has the least amount of appreciation. Sort of your outlying areas have the more rapid appreciation. The exception to that is Morgan Hill and Livermore, which are both on the cool side of or lower level of appreciation. Here's your sold price. And instead of following just the median, which is the middle number, I also follow the 10 percentile, the number on the left, and the 90 percentile, the number on the right. So you can sandwich what the price range is to expect in each one of your micro market areas. Here is your summary. And I didn't point it out, but I've numbered Santa Clara County all starting in the teens. So 11 through 17. Micro markets in San Mateo County are 21 through 26. In Alameda County, 31 through 37. The individual county is the actual 10, so 30, 20, and 10. And then Silicon Valley is assigned number 7. The light yellow up here is sort of somewhat indicating of the marketplace. The highlighted yellows, the bright yellows, are the ones that are the most indicative of the marketplace on predicting the market. And the overbidding requires sale price, so it's lagging, and that's why they're orange. And the magnitude is more important than the frequency of overbidding. Here's your actual raw numbers for either Santa Clara, San Mateo, or Alameda County, or Silicon Valley as a whole. The different metric. One of the things I wanted to point out is the drop in inventory. So we will start seeing fewer number of active listings going forward. This slide is becoming less relevant. We're now the third slowest year out of the last 25, second slowest year out of the last 2. 2023 and 2022 were the slower years, with 2023 being the slowest with only 1,827 slides or transactions. We had been the slowest or second slowest. Now we're the third slowest. We have been talking about Silicon Valley real estate market analytics for October 19th. We will be talking about the Greater Bay Area, which is 13 counties and 5 regions. I'd appreciate it if you'd like every video you watch and subscribe once. The YouTube archive here in blue gets you back to the channel. You can type in the shorter green root URL to join the presentation live Saturday morning at 9 a.m. Just add in the green root URL in 2024 and you get there. If it does ask you for the passcode, it's right here for you. If you want the handout, which is posted, you can type in the green root URL H for handout 2024-10-19 for the year, month, date code. Any specific past episode, you can get directly to it by doing the green root URL and the year, month, date code without the letter H. With that, I'm Richard Calhoun, a real estate broker with Creekside Realty. My contact information, we're representing buyers or sellers here in Silicon Valley. Let's move on to the Greater Bay Area. This is going to be the 5 regions we focus on. Silicon Valley that we've talked about at length already. Moving on to San Francisco and Marin, I often refer to that as the cities. North Bay is Sonoma, Napa, Solano, and Contra Costa County. Central Valley is San Joaquin and Sacramento, and the Central Coast is Monterey and Santa Cruz. Here is the active inventory. You can see that inventory is starting to roll over in Silicon Valley. It's flat in Central Valley and in the North Bay, flat in Santa Cruz, Monterey, and slightly down in the cities. The inventory has maxed out when you look at the raw counts in all 13 counties except for 2. And I believe those 2 are Solano and Napa. Here is the number of offers. In this slide I talked about at the very beginning. Notice how for the regions, the number of offers has gone up dramatically since September the 6th. And also in most of the areas, the level currently is at or above their previous peak. The one exception to that is Silicon Valley, where we're just below the peak earlier in second quarter. The Central Valley in the yellow is the most, it appears to be the most above their previous second quarter peak, followed by Central Valley above its second quarter peak, and then San Mateo above its second quarter peak. Silicon Valley is up dramatically, but still slightly below its second quarter peak for this year. They're all above their peaks for 2023. So offers accepted is finally coming back. Here's the days of unsold inventory. Notice the drop off in all the regions. So the market's getting to be a faster pace market, a quicker turnover. Yes, Central Coast is still the slowest at about 83 days. Then you have Central Valley and North Bay right at 60. Then you have the cities at 43, and the fastest is Silicon Valley at about 39.5 days of unsold inventory. That's the turnover rate. Now we look at marketing time. Marketing time, I use the benchmark of 3 out of 4 sellers are selling their home in less than this time. And that is basically going up in all the areas the last week and a couple weeks in most cases. The increase has been fairly significant since midway through second quarter, but then there was an improvement and now it's turned around and going up again. And so Silicon Valley has the fastest marketing time at 26 days. Cities is next at 36 days. Central Valley is at 45. North Bay is at 54, and the slowest is the Central Coast at 60. Here is the number of, this is the magnitude of sellers' price reductions on average. So you can see in Silicon Valley, we're taking a 1% price reduction. The area that's taking the most price reductions is the Central Coast, and it's almost taking a 3% price reduction. The other 3 regions, Central Valley, the cities, and North Bay, are all very close together at about 1.5% price reductions. Here's the frequency of those price reductions. So you can see that the area that's taking the largest price reductions is the Central Coast at 36% of the sellers. So just over 1/3 of the sellers are doing a price reduction. Also just over 1/3, 34% is the Central Valley. Then at 30% is North Bay, cities is at 20%, and the area that's taking the least price reductions is Silicon Valley at 16% of the sellers taking price reductions. We're about 1 in 7. This is the magnitude of overbidding. So cities in Silicon Valley are very close together at 6.5% over on average. I've tracked the median and that number is much lower. It's somewhere around 3% off the top of my head. But you got 2 areas of 6.5%. And then you have 2 areas very close to 100%, with the North Bay being about 0.5% above seller's ask price. Central Valley is about 0.25% below. And then the Central Coast is taking the largest price reductions at 1.5%. So buyers on average are coming in 1.5% below the seller's ask price in the Central Coast. The Greater Bay Area frequency of overbidding, the area that's the most overbidding is Silicon Valley at just right at 2/3 of the sellers are getting more than their asking price, followed by the cities at 60%. So 3 out of 5 sellers are getting more than their asking price. Then you drop down and you have the North Bay and the Central Valley on both sides of 42% for North Bay and 38% for the Central Valley. And the area having the least frequent overbid, under 1/3, is the Central Coast at 32%. This is the long-term appreciation since the last 9 months of 2015. You can see that the Central Valley, surprisingly, probably for a lot of people, has the most appreciation. Silicon Valley has the second. But if you break out and look at Santa Clara County is over 200%, if I remember correctly. I thought it was at 210% from earlier in this presentation. But when you add in Alameda County and San Mateo County, it drops down to about 84% appreciation. Central Coast is at 78%. North Bay is at 64% appreciation. And by far the area with the least amount of appreciation is the cities, with San Francisco and Marin being at 46% appreciation. So when you go from San Francisco and Marin to the Central Valley has doubled the appreciation rate of the cities. And if you come back and look at it, basically started just before the pandemic, because you can see that the yellow line and the orange line are basically patterning each other. And right here, about first quarter of 2019, Central Valley went flat, the yellow line, and your cities, Marins, went down fairly significantly. But then when you hit the pandemic right here, the mark was even greater. Central Valley really started to take off in the latter half of 2020. And then in 2021, it shot up dramatically. And then it had a run up and back down in 2022. But since 2021, it's only been up a little bit, because basically in 2021, it was at the peak here at 80% appreciation, and it's only 94. So it's only gone up 14% in the last 3 years. Here's the sold price. So the most expensive areas is the cities at something like $1.7 million, followed by the Silicon Valley at 1.6. Alameda County is, of course, what brings down Silicon Valley. Central Coast is at 1,100,000. The North Bay is at basically 780,000 maybe, and the North Bay is at 790,000, and the Central Valley is about 575,000. Moving on to the estimated monthly payments, and this is using a 30-year fixed for the nation, an average, and it's also doing an 80% PITI payment. So your total monthly payment, if you're putting 20% down on a 30-year fixed at the national rate, you can get lower payments by doing several different things. We're looking here at the cities has the highest monthly payment, followed by Silicon Valley, Central Coast coming in about 8,000, North Bay coming in around 6,000, and the Central Valley having the most affordable payments, probably just over $4,000 a month in payments. Here's the actual raw data. So you have each one of the 13 counties. I do have Silicon Valley as a region, and I also have Bay Area. I believe the Bay Area is a complete garbage number. I only include it because the media talks about it so much. You can see that Silicon Valley, Santa Clara County has the highest median price by 23,000 above San Mateo. The third place is Marin at 1.8 basically million. So you can see there Silicon Valley, Santa Clara County, and San Mateo County are pulling away, and Santa Clara County is now currently the most expensive. But we pick up whatever metric is the most interesting, and yes, I was correct. Santa Clara County has 205% appreciation, which is the highest of all the regions. The next highest is San Joaquin at 98%, and then Sacramento at 92%. So I'm not seeing any unmuted mics, so have a great week. Take care. Thanks for listening, and please like the video.